Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Hello, welcome to another ChrisMartenson.com podcast. I am your host, of course, Chris Martenson, and today we're speaking with Harvey Organ, who runs Harvey Organ's daily gold and silver report at harveyorgan.blogspot.com. He's been following the precious metals very closely, far longer than I have, and I've been following them ever since I was a kid, picking silver quarters and dimes out of rolls, back in the day when you could still do that. And he's been doing all of this work around the precious metals, despite having a day job, knows all about the inner workings of the COMEX system, which I hope we're going to have an opportunity to hear some of today. He has testified before Congress on precious metals manipulation, and knows Bart Chilton and the CFTC folks well. We'll discuss his views on these folks today. And his point of view is that there's much less physical backing the system than folks realize, and that it is the U.S. government, or its proxies, I guess we'll get his views here, conducting market influencing manipulation, whatever term makes you less mad, to keep the lid on things for as long as they can, which he doesn't think can be much longer. Harvey, welcome.
Thank you so much for having me.
Well, fantastic. Let's just start with right at the outside with precious metals. Very interesting market action today. We're seeing the Dow roll over a little bit. Europe's getting killed a little bit. Some weakness in some of the financial shares out there, particularly in Italy. Precious metals have been taking their lumps lately, except maybe gold's holding firm today. What are your views on where precious metals are today and where they might be headed?
Terrific. Gold has really held, as you've been seeing for probably the last year or so. We've been seeing when the Dow gets hit, gold gets hit, and the banking cartel continually do raids on gold, more to contain the price over the long run. But the long run, gold and silver will rise, and they're doing their damnedest to try to keep the lid on these precious metals. Today is very, very unusual in that we're seeing Europe probably implode. You're seeing the DAX down almost 2.5%, the CAC current down 3%. You're seeing the Spanish yields rise to 5.96%. And the Italian 10-year bond rise to about 5.3%, something like that. Mm-hmm. And this is getting scary for the world. And I'm just absolutely ecstatic to see that gold has been now holding, as you see, it's now rallying, despite the Dow being down. And the reason really is that the open interest on gold has dropped dramatically. Down to the 399,000 level, and there's no more fat for the bankers to skin anymore. That they're gone. The COMEX traders are now in strong hands, and probably in silver too. And this is what's giving the support now. So even though the bankers are trying to raid and to fleece as many of the longs out of the COMEX as they can, they're just failing today. And gold, even though you're seeing the Dow now down 152, gold is basically at par at 1642 now as we speak. Right.
So we're seeing a little bit of that correlation is breaking down potentially today. Always a good sign. So let's talk about how the actual gold market runs, or gold and silver market. So we've got a physical market over in London, and then there's primarily a paper-based market over in the U.S., although let's break that down a little bit. How does the U.S. market run? It's mostly trading in paper, but you're mentioning something called open interest, and we know also that people can take delivery, so there is a physical backing to the system. Just briefly, how does the U.S. system work, and what are the big pieces that we like to keep track of?
Yeah, you hit it exactly correct. The real physical market is over in London. And you have your Chinese, your Russians, and I'm talking Russia, sovereign China, will always take forwards and take delivery over in London. So it is the dominant market. Whereas over here in New York, it's a paper market. And when I have an open interest, which means I am along and I want to stand for delivery, if I really want physical, I wait for a delivery month, and I just wait and then plunk all my money down and take delivery. This happens very infrequently in delivery parts in this part of the world. So in other words, if anybody really wants metal, they would go to over London or probably Singapore or Hong Kong. However, the bankers know this, and they manipulate the paper business, which is over on this side of the pond, and actually influence the price, which is what you're seeing, which they tried to do today, and of course failed. So they will whack, and they will certainly use the help of their friends at the high-frequency traders who have built their fast-speed computers, and then they can manipulate prices. They collusively do this. Bankers will withhold all their bids for gold, tell their friends, wait a minute, we're going to whack today or tomorrow morning, so we're going to hold our bids, and I promise you your gold will be cheaper in the next 2 days or so. And this is how these guys do it collusively. They'll do it both in silver and gold. And it kind of hurts guys who are trying now to play the COMEX, and you just can't play against these crooks because they'll fleece you. The only way to play in the COMEX, which I tell people not to, but it's just put your money down, don't leverage, and just stand there and take delivery, which is what I did at the COMEX a few years ago. And don't pay any attention to price. If you're impervious to price, trust me, the price of gold in the next few years will be much higher than what it is now.
So I was talking with Paul Testain recently, and of Bullion Vault, and he was saying that the reason that the big banks tend to stand on the short side is because that's the side you stand on if you want to have the best chance of earning money at anything, because as the short, you have an option, which is you can always just slide the metal across the desk if that's what it comes to. On the long, you don't have that option. So if you are going to be somebody who's going to collusively manipulate a market for financial gain, you really are going to be playing on the short side of that market in this particular example because of how the futures market works, because of that asymmetry where you have that option of just sliding the metal as it happens. I've also noticed something. This is my own anecdote. I don't have a lot of data, but there were the moments when like silver got killed for 25% that one night, right? It started somewhere in Asia.
I remember that, February 29th.
Yep. And there are other moments I will notice, particularly as soon as the New York market is closed and the Globex market opens, the thinly traded one. Mm-hmm. I will see sometimes thousands of sell orders just crowd the tape.
Oh, 100%. You're trading with nobody. You have no counterparty. So when you have a seller who has no interest in profit, okay, this is what these guys do constantly. There's no profit motive for them, and then they will manipulate using their friends. So in other words, they can stuff the channel with these phony bids and asks, and that will immediately drive it. So they utilize very little of their ammunition and let the high-frequency traders carry this down. Oh, there's so many stupid games that they played, and I certainly have voiced my concern to the CFTC constantly on this. I've on the raid on the February 29th, I was actually on the computer, and I saw it drop $3 or $4, and I wrote to Bart Chilton at that instant and said, we're going to have a massive raid. And I was right. And he commented that with other people, that I was able to tell that a raid was on. There's other ways that you can tell by gold will be rising and silver will be languishing. That's one. That'll tell you that they're manipulating. The second is that gold will be up $10, $15, and then gold shares, equity shares, will be in the toilet. That's a sure sign that a raid is being orchestrated. And these bankers make money. There's no question. You're 100% right. They make a lot of money on the short side because they don't utilize that much ammunition. And to prove it, always on a down day, it's the bankers that come in to cover their shorts. Always, 100% of the time. So the COMEX is supposed to be a price discovery mechanism, not the price. And we keep telling that to the Commission. And this is their mantra, and they're violating their own rules. And I'm going to tell you another thing, which I told the CFTC. And in front of me, the Commissioner O'Malley goes and says that when they're trying to do position limits, he stated to me, well, maybe we're worried about business leaving. So I wrote to all the commissioners and says, well, if that was then, why are you not concerned? You're seeing the open interest drop dramatically in COMEX because people are now leaving the business because you can't play against this casino, and you're not concerned now? So in other words, they're talking on both sides of their mouth. But there's no question, and trust me when I tell you, gold and silver are manipulated 100% of the time. So they are manipulating every second.
This is something I've observed for a long time. I did trade gold and silver futures for a number of years, and I've been out of the business for a while because it was just too frustrating. I would watch these raids come in, and my fingers were too slow. And I found that if I ever set limits, that was a sure way to get my pocket picked.
That's correct.
I had the distinction of one day having the absolute lowest limit that was touched for just a microsecond, long enough to sweep it. So silver literally plummeted 5% and gained most of that back, but that 5% was plenty to go grab my future from me. And so I've seen this happen over and over and over again. And so I came to the conclusion that there's an asymmetry going on here. There's players who either see more of the book than I do. They have more firepower. They may be operating non-economically. Because here's the thing. Whenever I would see a big dump in gold, of course, the Wall Street Journal or some other organization of similar repute will come along and say, oh, it must have been a hedge fund liquidating. And it always confused me because I was like, well, listen, hedge funds, these are smart guys. Who tries to liquidate their portfolio position in a single 1-minute candle by selling everything they've got all at once? Nobody does that. Nobody.
You hit it right on.
So
that is exactly correct. These bankers are not for profit when they sell. Okay, so in other words, they whack continually down in order to knock the price down. But remember, the demand is so high for gold and silver, but by sovereigns. This is their Achilles heel. And you're going to see it today. Today, what happened is the physical demand was outstripped the huge supply of unbacked metal today. So all of a sudden, now you're seeing gold rise because the physical overpowered them today, despite the Dow being down 144 points. This is an unusual day today.
So in many respects, I've been watching this for a long time. So let's 10 years for me, not nearly as long as you, but over those 10 years, I noticed this is starting back when gold was in the low 300s.
Yes.
And so
I remember that time.
Yeah, and silver was.
I can remember it was 250.
Yeah, right.
Okay.
You were there for 98, right? So
I was there in 98. Yes.
Yeah, I wasn't quite to the game yet, and silver was about 450 when I started watching all of this. So
that is exactly correct.
Once upon a time, I was excited when silver would rise a nickel. Things like that. That was a big day. So at any rate, as I watched this, though, back then I would have to characterize gold and silver demand as relatively moribund. Wasn't really on anybody's radar screen yet. It really wasn't being held by all that many participants. You didn't read stories about how all the safe deposit boxes in Germany were crammed full. All of that. It was a much more sedate market at that point in time. It's at the tail end of a 20-year bear market, obviously.
That's correct.
That game that you're describing, where the bullion banks have found a way to sort of, I believe that how would I put this? I think what they did was they developed a way of operating in the silver and gold markets that applied back then. And what I'm confused by is how they can still run that same game in the face of rising physical demand. That I can't square those two pieces up.
I'll try to do the best I can for you. The suppression of the metals started probably in 1988. That's when the leasing game was invented by J.P. Morgan. And these guys would go around to the mining companies and say, listen, I'm going to pay you for your gold in the ground, and I will sell it, and then you just pay me as you bring it out. So that was kind of cheap financing to the miners. And of course, Barrick, the biggest mining company of them all, went in on this, and it financed a lot of their Nevada projects and everything. And once the leasing game came, that the actual selling, the extra selling, suppressed the price. Okay, and it started getting first 5 years of maybe 300 tons, 400 tons. It doesn't start to get really bad until probably 97, 98 with the long-term capital affair. And that's when the leasing started around maybe 1,000 tons of gold. And it hasn't stopped. And silver is the same. The leasing of silver suppressed the original supply, I guess, came from Buffett. But banks would borrow silver by leasing it, and that would go into the market. And for many years, that's why you had a long-term, 20 years of suppression of the metals. Now the problem now is that the physical is now gone. Where is it going? It's gone from west to east. So the gold that's in probably Fort Knox is gone, and our friends over in China, who learned from us very well, has said, I'm just loading up the boat. They're loading up their boat in oil, you can see that, and silver and gold. A lot of people don't know that. China used to refine probably close to 80% of the world's supply of silver because it's very toxic, and you get this silver oxide, and it's very... So up until probably 1980, 85, these guys the Chinese were 82% of the world's refining of silver. Now I think they're down to 40, but still a major part of China's industry is silver, and they're just not they're keeping every single silver ounce they refine, and gold. They're keeping it for themselves. Their reserves are rising. They don't tell exactly. About 2 years ago, they went up to 1054 tons, and I can assure you it's probably triple that now. These guys are not stopping, just like they're not stopping in oil. And they know what the game is, and they're slowly taking all their U.S. dollars that's on their shelf and converting that to gold, oil, copper, everything that's real. And the game ends when the last ounce of gold has left London, and that's quite some not comics, because once in a nanosecond it'll come back to here. Mm-hmm. The big problem in London, as Jeff Christian kind of said at the hearings, was that their derivatives on the gold is about 50 to 100 to 1. And he's right. That's the amount of derivatives. So if I take out that 1 ounce, the balloon around it, the derivative's getting bigger and bigger and bigger until it's ready to totally implode. And that's what you're seeing now. So right now, you can, and I'm telling, people are going to say, how high can it go? And I'm going to tell you. You're going to go to sleep on Thursday night, and gold maybe 1670, and then you wake up the next day, there's going to be a banking holiday, and gold will be 3,000 bid, no offer, and it'll be a banking holiday, because there'll be a failure to deliver.
Well, my experience with say, the Hunt Brothers or MF Global recently, there's a thread here I can tie together, which is that when things get really bad, they just change the rules or they ignore the rules. They changed them on the Hunt Brothers. They ignored them in the case of MF Global. I mean, there are rules and laws against doing what they did, right? But none of those seem to have been enforced yet. And maybe never will. So one of my views has been that I really advise people, if you have physical gold, you've got something. Everything else is a proxy on it.
100%. I will you can't have anything paper because you got nothing. Right. You got to have a physical coin or a bar, or you have to have that piece of paper. That's all it is. They'll just blow up in smoke.
Yep.
You see, you can't have it. By the way, in the Hunt Brothers situation, it's interesting. There was above ground 2 billion ounces of silver at the time in 1980. A lot of people don't know that. And the Hunt Brothers kind of thought that the United States would not utilize that. But in essence, they did. Now, that 2 billion above ground ounces of silver is gone. There is none left. And I think that's where I think there's more of a shortage in silver than there is of gold. Gold is every single ounce that's been produced is still on the surface of the earth. Somebody has it. silver is consumed, and there isn't any.
Excellent point. I try and make this point often, and I don't know if we can make it often enough, is that I don't talk about gold and silver as if that's one word. They're two separate, very separate substances to me. And gold is a monetary metal, and I love it because I think there's a chance that at some point we may have to go back to a gold standard when we discover that the floating exchange rate system just really doesn't work.
Chris, it has to happen.
So if that happens, if gold gets remonetized, you mentioned 3,000. Well, I could pick all sorts of silly numbers, what would be silly today. But in truth, if we had to go back to a monetary backing by gold in any sense, it would have to be extraordinarily higher than it is today.
For sure. You got trillions and trillions. What is it? The United States has got a total of, $100 trillion of obligations plus debt, and they're 25% of the world. So, my goodness, it's so huge. That you pick a number. And that's the only way they're going to restart the world is just revalue gold and start again. You default and start again.
Yep.
I mean, that's the only way that they can do, and it's, in history will tell you.
Well, there is one other option, which is to bite the bullet, admit that you overspent, and go through austerity. But, we're going to see what that really means because Greece is playing out austerity right now. And you discover that austerity doesn't end or fix anything until you hit your true bottom, and it's a lot lower than we currently are. So I don't think the stomach exists out there in the political landscape to truly bite that bullet. I think a default of a different form, which would be to basically just reset everything against a new proxy of some kind, which should be gold. That makes sense to me.
I think that you guys should kind of watch dramatically Spain. That seems to be the focal point now. Greece was just a warm-up. Mm-hmm. It was a small, it's 2 to 2.5% of GDP over in Europe, but the real problem is Spain. They're sitting, and the problem now is they've got, this year, in 2012, they got about 186 billion euros coming due. And you can imagine that they had problems with funding Greece with 14 billion euros. Look what they are going to have a problem. So, like Spain, actually, it's 124 billion euros coming due, but they're going to need to print 186 billion to pay for that, plus their deficits, which are 5%, 2 to 5, whatever it comes out at for this year. Spain is going to be a real problem, and you cannot firewall. There's just not enough money, euros, floating in the system. So they're actually trying to call the United States, the IMF, and the United States again. They got their own problems with their debt ceiling and everything like that in Europe, and Japan's got its problems. They're all printing. So I think that you all have to really watch Italy, Spain for sure, and then Italy. But Spain could be enough where it can drive the complete failures of the sovereign debt, which would cause the banking to fail. And the reason is the banks are 300% of debt to GDP, which is their leverage is unbelievable there.
Yeah.
So you will have just a massive printing of money. And if you were a citizen of, let's say, Italy or Spain, you're not going to keep your monies in euro. You're going to run over to Switzerland and convert to gold. And you're seeing a massive run on the banks. And that's what's exactly going on.
Yeah.
And so I would really, and I write constantly on those issues. Like Spain, I knew was a big problem. Italy is too big to fail. And I guess another way of looking at it is a Lehman times 10. So if you can imagine the mess that Lehman did, this thing will just be dramatic. And don't think the United States can be left out of this. It's 70% of the entire reserves of the world. So if Europe fails, so does the United States, and it'll be a catastrophe.
That's why I was watching. I think it was last week. Spain had a bond auction that caught my attention because they wanted to sell 3.5 and they sold 2.6 or something
at a high yield.
At a high yield, yes.
And it failed. That's the first. Remember that these guys got in February 29th, they did an LTRO, which is a long-term, it's a 3-year refunding. And 1 trillion euros was now given to the banks of Europe, of which Spain and Italy got 14% of that funds, and now that money is run out. Why? Because the yields are now back up to where they were before. So that's the signal that there is trouble. There's trouble in Europe, and that's why you're seeing France down 3% today, and the DAX down 2.5%, because Europe realizes that the LTRO funding has now failed, and if Europe fails, the euro will crash, and if the only way out of this would be probably for Spain to leave the euro. That's the only, it has to do that. Or Germany leaves, because they're going to have to massively print euros to save it, which is very, very good for gold.
Well, I'm on record for years and years now that printing is what we're going to do because the alternative is just too painful. And history, you read Rogoff and Reinhardt's work. This time it's different. You discover that this has always been true. So I'm a betting man, and I kind of believe that humans have not fundamentally evolved in our core wiring. So I think that what's going to happen is what's always happened. We'll print. It's kicking the can down the road. Your position is that maybe we can see the end of the road. There's certainly some very big stresses. I noted that 2008 we have this crisis, right? And that's our moment. Shot across the bow. And what's happened since then? If we take our 3.5, 4 year later scorecard, we say, well, derivatives are now 100 trillion higher than they were at the moment of the crisis. It looks like the bank balance sheets have been repaired somewhat, but they're probably not back to their pre-2008 health by any stretch. Sovereign entities now have extra debt because they've been over here trying to lever everything back up on the public side of the balance sheet because the private side has stepped away. And we have unemployment that's surged past, I think, recoverable levels, specifically when you look at it on that generational scale. With Spain, 50% of their 24 and under crowd out of work. That's
53,
just, yeah. Oh my gosh,
53%, yeah.
Oh, that's
and 26% overall.
God, that's a lost generation we're talking about there.
Well, look, the youth. You can't have the youth not having jobs. I mean, you're going to have rioting on the streets. You're not protected. You have no economy. And you're going to do austere measures in this nation? How can it possibly? Your GDP will drop even more? Rajoy, the prime minister, he knows. You can't do that. It just won't work.
Yeah, Rajoy's been on record recently saying that things are pretty dire over there. And so
yes. I'm just telling you, Spain is a crisis. It really is. And I think you should concentrate a lot on Spain for sure. Italy. Another one is Belgium. Their big Dexia bank is in a mess, and it is somewhere. Its debt to GDP in the bank is somewhere around 300% over its GDP. So if they have to absorb the cost, then of course Belgium can fail. And then you have Austria supporting Hungary. So the banking system there, so Austria can fail if Hungary defaults. So you can have contagion just in a nanosecond spread all through Europe.
Well, now, if the euro does fail, because one or more of these entities we've been talking about fails in some way, shape, or form, there's a point of view that says then the dollar will benefit because there will be all this money that has to leave the euro suddenly. Where will it go? It'll go into U.S. assets. It'll be sort of that final plunge towards the center. Isn't there a chance that rapidly rising dollar, if that comes to pass as the outcome of this, that would actually really trounce both equities and commodity markets?
It could. But what I really think, well, remember, the United States also has its problems, too. It's not great. I mean, it's got its ceiling. I mean, starting in September, they're already going to hit their debt ceiling. The Republicans are not going to get away with the social programs of Obama. So, I don't think it's going to happen that way. That's my opinion. It could. In other words, Europe faltering badly, which causes the dollar to rise dramatically, which in turn will hit the commodities. But I really think the entire globe is in trouble, collectively. And they'll all go down, and people will realize that, wait a minute, we can't fund pensions, all the pension funds, and we can't fund everyone's assets in the bank. When you have, all of a sudden it was so much run on the bank. How am I going to pay depositors everywhere? And look at the life insurance companies. They cannot make money anymore, and they got to pay out. Everybody has to pay out, and there's just not enough money. The collateral is disappearing. That's another issue. Collateral, which is in that part of the pond in Europe, this is the markets that funds the money markets, and collateral is disappearing, and their money markets are disappearing. Which is why Europe is collapsing. It's everywhere. It's just not. It's everywhere. You got Japan. Japan has a debt to GDP of about 250%, and it's been saved by its citizens being old. They're older, but they've been funding. All of a sudden, they're drawing now because they're old and they got to live, so they're drawing their pension. And now they have an energy crisis now because all their nuclear plants are now offline. All of them. So now they have to import liquid nitrogen gas, LNG, and it's very costly, and they get brownouts there. So all of a sudden, the economy over there in Japan is trouble. Okay, and now that leads to the and the United States. Listen, the United States has about $3.8 trillion worth of expenditures. It has $2.2 trillion of tax receipts. And they call the difference the jaws of death, which is $1.6 trillion. Who's going to fund that? So the United States, so Bernanke goes and states, wait a second, we're not going to monetize anymore. Well, nobody's asking the question, well, who's going to fund the $1.6 trillion? No, Europe isn't. Europe's in a mess. England is still monetizing because they're in a mess. There's nobody there to buy it. So in essence, the United States is actually printing and monetizing their own debt, and they're doing it through swaps, and that's how they're doing it. So really, they're all printing massively, and that's why you guys should all just don't pay attention to the background noise. Just go buy your physical and be thankful that you're getting it at a cheaper price today.
This concludes part 1 of this fascinating interview with Harvey Organ. In part 2, we discuss all things silver. How much gold is there really backing the major ETFs, and Harvey's 2012 forecasts for bullion prices. Part 2 is reserved for chrismartinson.com's enrolled members. To learn more about enrolling, please visit chrismartinson.com.